Gold saw its biggest intraday drop in a year on Monday in a blow to the gold bugs, descending from a 6-year high. This after the US and China agreed to restart trade negotiations, spurring risk-on sentiment across the markets. Joining me to discuss the outlook for gold prices is Mark O'Byrne, founder at Goldcore. Mark, good to see you as always. Gold very much front and centre for investors right now. The sharp rally we've been seeing recently, followed by this sell-off this week. So do you think this volatility is here to stay?
I do indeed, yeah, and I think that the gold bugs are set to have their day again. Yeah, because unfortunately, I don't think the the trade wars and the various geopolitical uncertainties we see in the world, including Brexit, the US-China tensions, the US-Russia tensions, the problems in the Middle East. I think these are long-term issues that are here to stay, unfortunately, and therefore that bodes well for the gold price in the medium and long term. But I think you're right in the short term. I mean, gold had become very overbought in the short term, and we were due a correction, and we clearly flagged it mid last week that we're overbought and we're due a correction, and I think we're in the start of that correction phase.
All right, so you say that we could be in a correction phase, but you mentioned in your blog this report from Credit Suisse saying that gold could retest the record high. So, I mean, do you think that Monday's price action derails that projection?
No, I don't. It just merely delays it. So, I mean, we had very, very strong gains in June. We were up 8%, and we appreciate very significantly indeed. And I think typically in that sort of a move up in the short term, you would see a 50% retracement. So I wouldn't be surprised if we go back to the previous resistances around the 1350, 1360 level, and potentially we'll go back and test those levels, and that resistance will become support. But I think Credit Suisse and ourselves and many other analysts, most of the analysts are quite bullish on gold in the medium and long term now. I mean, we're talking about record nominal highs, and I think it's 1921 is the record nominal high in dollar terms. And I think that is quite likely, a 2, 3, 4 year time frame. So no one's saying it's going to happen in the very short term in the coming weeks and months, but I think over a 2, 3 year time frame, it's quite. I think it's quite likely actually, given the very strong fundamentals for gold.
So what do you think it is that's really dictating the price action in gold? Is it more on the US dollar side, or is it more sort of as a function of risk? Which one should we be looking to more in order to gauge future price action?
Well, it's a bit of both, and there's a bit of risk to the dollar itself, given Trump's management of the U.S. economy and his foreign policies and all the rest of it. So, but yeah, so on the risk side, I definitely think obviously U.S. stocks are all-time record highs, despite the little bout of risk aversion that we saw last week. So risk assets, both stocks and bonds, are near record highs, particularly in the U.S. markets, and particularly on the tech side of things. So risk on has been on for a long period of months, and I think we're going to go from that risk on to risk aversion, I believe, in the coming weeks and months, and that bodes well for gold when we see a correction in stocks, obviously. But also on the dollar side, I mean, Trump, the budget deficits in the US are heading to well over $1 trillion, $1.2 trillion a year. There's concerns about the dollar as the reserve currency in the medium and long term. So I think there's real risk to the dollar as well, and that will support gold. And one other thing that is really supporting gold is there's over, I think, $13 trillion worth of bonds internationally that are now negative yielding. So we've NIRP, negative interest rate policies. Central banks are loosening again, and basically people aren't getting a yield, and that's a very bullish environment for gold, because gold's great. The negative of gold is that it doesn't yield anything. It's a non-yielding asset. But when you're in a world of 0% interest rates, or indeed negative interest rates, then gold becomes almost a higher yielding asset in that climate, which is quite bullish for gold. I think that's a real fundamental pillar that's going to support the gold market in the coming months and years.
Certainly, it's a difficult time to find yield, that's for sure. But in terms of your outlook for the next 6 months, say to the end of the year, what's your year-end target?
I think, yeah, at the start of the year we said 20%, and I think we'd be sticking to that. So maybe revise it up a small bit. I think $1,600 is quite possible. You know, we might get up as high as 1,700 and then pull back. So I do think, yeah, that would be probably around 15% from these levels is very, very achievable indeed, given the fundamental backdrop.
All right, now let's move on to silver. Give us a sense of your outlook for prices there.
Yeah, well, would be more bullish on silver. It looks fundamentally undervalued vis-a-vis gold and indeed vis-a-vis other assets in the world. And the ratio it's about 80 to 1, between 80 and 90 to 1. So, we're talking about, just looking at it here, $13.92 and 15.11. Sorry, for gold, for your listeners, $13.92 per ounce for gold and $15.11 for silver. So, as I said, about 80 or 90 to 1. So it looks undervalued. It didn't move up as much as gold moved up recently. It didn't break out technically. But I think that most precious metal analysts are more bullish on silver given this fundamental undervaluation, and that is because silver is used in a huge amount of industrial applications. So from a demand point of view and indeed a supply point of view, a huge amount of silver has been used up in industry and in technological applications over the years. So above ground refined stock of silver vis-a-vis gold is actually quite low, and all it takes is a small amount of extra demand for silver, particularly on the investment side and in terms of the ETFs and for coins and bars, and that would propel silver prices much higher as happens during the bull market. So silver tends to be like a leverage form of gold, and when gold tends to go up 1 or 2% a day, silver tends to go up 3 or 4% a day. It's a more volatile form of gold, but conversely, if gold falls 1 or 2% a day, then silver will fall 3 or 4%. So we would be more bullish on silver, and we believe longer term that silver is going to surpass, obviously the nominal high for silver is $50 per ounce in January 1980, and then $50 per ounce again in 2011. So we believe it's very easy, it will very easily surpass those levels in the coming months and years. And if you adjust for inflation, the silver high is about $130, $140 per ounce. I think in the longer term, 3-5 years time, that's quite possible.
Mark, thank you so much for your time.
Pleasure, Victoria. Thanks for having me on.
That was Mark O'Byrne from Goldcore. I'm Victoria Scholar, and thanks so much for watching IGTV.